National Stock Exchange of India has been actively involved with initiatives to educate the young generation of our country on the importance of financial management. One such initiative is NSE FinWiz that focuses on educating and advising the young workforce of the country on wealth management to enhance financial literacy and to empower
Insurance is for protection and investment is for growth.
Another program facilitated by NSE IPFT is NSE Financial Quest. This inter-school financial quiz contest goes an extra mile by educating the young students on fundamentals of finance.
What is this?
It's the formula for the simple interest.
Simple interest is the right answer.
Under the NSE Financial Quest Base Camps banner, the program engages students around the year through workshops on various topics, projects, interactive videos and quizzes.
DiCaprio is bouncing checks off hand hand.
Plus 75 Plus 75.
To facilitate these two programs, NSE along with CNBC TV18 has travelled across the country to bridge the wide knowledge gap in terms of finance. In this episode of NSE FinWiz, we are all set to achieve our objectives once again by gauging young professionals in a new city. Leader in package power technology, Exide India Limited is one of India's largest storage battery companies with the widest range of conventional as well as latest VRLA batteries. Exide designs, manufactures, markets and sells the widest range of lead-acid storage batteries in the world. Apart from serving the domestic market, Exide also exports batteries to Southeast Asian and European markets. Exide has 9 factories located across India. It is the only company with manufacturing units in multiple locations across the country and equipped with cutting-edge technology. NSE FinWiz visited the Hosur plant of Exide India Limited along with the experts to gauge the thoughts and notions of the employees with the theme Dreams Come True.
From my short-term investments, I expect a rate of return of 10 to 12%, which will take care of the inflation, as well as that will give me some return also. And so far as the long-term investment plans are concerned, since it will take care of my retirement plans as well as higher education of my next generation, so there I will have an expectation of 18 to 20% return.
I have started my investments and I'm undergoing various investments so that it secures me and my family for any sort of financial risks.
And I have short-term goals, which is taking care of health and everything. And my long-term is investing in the properties, land and golds, which is already I am doing.
My long-term goal is to own a big car, a palatial home, and ample resource to vacation at a good place whenever I need. Plus, I believe that finances doesn't only mean monetary gains. It can also be expressed in terms of your self-satisfaction and joy provided to family. So I dream of that also.
Hello and welcome to Season 4 of NSE FinWiz, powered by CNBC TV18, and I'm your host Nitya Balakrishnan. Today we're in the plants of India's largest tubular inverter battery manufacturer, Exide, in Hosur. And for this episode, I'm joined by 2 very special guests, Kalpesh Ashar and Uday Doot. Thanks so much for joining us this evening. My first question, Mr. Doot, if I can ask you, is there ever a right age to start investing? And when you talk about investment in India, for some reason it happens to still be via very traditional routes. Savings bank account, PPF, that's the maximum that many of us have pushed it to. What are the other vehicles that one can look when you are thinking of investing right at a very young age?
In terms of investing, I think for many things actually we are very, very traditional in our approach. And that's how NSC and PPF and LIC sort of have just been sort of synced in our mind, and these are the only things that we could do. And very few in between people kind of look at investments. But what is going to happen is that I think we are changing as an economy, our requirements are changing. As a society, we are changing. I think, just think about it, many years back, pretty much all of us were staying in joint families. Now, hardly anyone stays in a joint family. Everyone is on their own, which means that earlier joint family system was nothing but society's way of providing insurance. Now, you need to provide for that insurance all by yourself. So, you can't look at what your parents did or what kind of insurance they bought, and you buy the same kind of insurance because your parents and us are in completely different environments. So the way we manage our money has to be very, very different. Things like term insurance, SIPs, looking at investments from equities are very, very important and things that we all need to look for.
All right, Kalpesh, can I ask you to jump in here on if there is any healthy ideal mix for one's portfolio? And we are looking at a time when demonetization is something that's happened in recent weeks. You're talking about a lot of panic that was initially created on the backs of this announcement. Suddenly, gold and real estate, nobody knows whether they're going to be good or bad investment. So talk to me really about balancing one's portfolio, and what would you look at when you do the same?
Yeah, so first of all, just a little add-on to what Uday said, that we Indians have always been good savers, but never good investors. And there's a whole world of difference between saving and investing. So what you save and keep it in your savings account or in your piggy banks or back home, that is just not going to multiply. But what you invest is going to help you in the future because that multiplies. And which are the vehicles which help you multiply your wealth? Those are manifold. So there the options of equities come into the picture. There comes debt mutual funds, because that also is a better option than a conventional bank FD or letting your money just stay idle in a savings bank account. So there has to be a clear separation between savings and investments. So let's get onto the investment part here first. And as they say that many people do not, when you associate the word investment, they say it's very risky. But many big thinkers and people who created wealth, they are of the thought that the biggest risk is not taking a risk at all. So if you are not ready to take a risk, how will you ever grow? But that is where the concept of financial planning comes in. And financial planning teaches you that what exactly is your personal profile, on which basis you are supposed to take a risk. And once that path is set out, answering your question now, the demonetization or any presidential change in the leading democracy of the world, nothing can upset your own plans. Because you have set out on a mode which nobody can upset.
Fair enough. When you talk about the equity markets, how would you advise a beginner to go in and start looking at what kind of mix? Debt funds, hybrid funds, or equity funds? What are we looking at?
See, I think the most important thing, apart from whatever both of us said, is that I think there is one common enemy that we are all fighting, and that is inflation. Now, this is a common enemy that all of us are fighting. And you look at all our expenses. What are our expenses? Our expenses are the regular eating out, this, that. Then there are expenses around health. There are expenses around generally maintenance of our lifestyle. Now, if you have to maintain any of this, we have to have assets that are earning returns around that. We can't be having, if the cost of, say, let's say cost of health. If the cost of health is going up by 10%, say a typical same operation or same kind of a medical equipment was costing X amount, it's going up by 10% year on year. You can't have your investments growing by just 5.5%. Right? You need investments which is growing at a higher rate. So that's where the need for higher growth investment comes up. We all have our own specific goals. So the important thing that you need to do is that you need to put aside what your important financial goals are. It could be a holiday, it could be a house, it could be a retirement, it could be a car, it could be a medical emergency. Then start working backwards and saying that, hey, what do I need to do to achieve that goal?
Absolutely. In fact, here is what, ideally you've been talking about, which is ensure that there is short-term, medium-term and long-term goals in sight and start saving accordingly. Because multiplying wealth over the long term is fairly easier. With that, Kalpesh, I'd like to ask you about SIP and ELSS, because in the past you've indicated these two routes as fairly sensible ways of approaching investment.
Exactly. So when we say SIP, I think many of us would be aware of it, but for those who are not aware of it, SIP is nothing but systematic investment plan. And we all have heard about it. It's been advertised everywhere. Systematic investment plan does not mean a small investor plan. It's not that a person having a small amount cannot invest in it. Because an SIP in mutual funds starts with as low as rupees 500 per month. You can get started. So it's not the amount. So SIP does not stand for a small investor plan. It's systematic investor plan. So the necessity is getting on board as quickly as possible. The other aspect, the ELSS. Like many people surely, as soon as February or March comes, they all of a sudden come out of a slumber and say, oh, my tax planning needs to be done. And they run about buying either wrong insurance policies or getting into housing loans and all those things. The ELSS is again the shortest form, the shortest period in a Section 80C instrument, having just a lock-in period of 3 years. And ELSS is equity-linked savings scheme. So you have your participation into the equity market, you save tax by the amount you put in into that financial year, and you can do it the whole year round. You don't need to only invest in February or March. So if you have planned it in advance, probably April to March, the 12 months, you can have your ELSS investments allocated towards equity. And after the 3-year period, the normal ELSS which you have put becomes an open-ended fund. So that needs to be taken in consideration for the long term.
On that note, it's time to slip into a quick break right here on NSE FinWiz, but stay tuned. We're going to throw the spotlight on gold as an investment opportunity on the other side. Welcome back. We're still in conversation with Kalpesh Ashar and Uday Doot in Exide in Hosur. And right now, I want to throw the spotlight on the precious yellow metal, gold as an investment opportunity. My first question to you, Mr. Doot, will be, when you talk about purely for portfolio diversification, do you think gold is a good addition to one's portfolio simply because of its universal, acceptability and easy liquidity to a large extent?
Gold is like an insurance to your portfolio. I'm saying, don't buy gold beyond that. I'm saying, why do you buy insurance? If something happens to me, my family should be taken care of. Likewise, you buy gold if the world really goes down, like everything sort of breaks down, then maybe gold will be useful. So you buy gold only as an insurance for your investment portfolio. You don't buy gold as a large part of your portfolio. Because if gold really starts doing well and doing extremely well, be rest assured that the economy is in doldrums, which means that your house, your investments, the companies that you are working for, all of that is not doing well if gold has to do extremely well. So I think gold should be like 5 to 10% of your portfolio at the max, not beyond that, because it really does not have any kind of a regular income that it generates or dividend that it gives or interest that it gives, so it should only be that much.
Kalpesh, if I could play the devil's advocate here. On paper, a lot of people seem to indicate that gold is an excellent hedge against inflation. We're talking about a time Brexit has taken place, Donald Trump is the President of the United States, a little bit of uncertainty in terms of, our current economic situation and currency situation. In this point, do you think it's not really the smartest move to look at gold as a safe haven of sorts?
So basically, the fundamental thing is that all of us Indians basically have bought gold under emotions. So it's never been a financial decision, it's been an emotional decision, let's understand that. So whether it is out of euphoria, so whether you want, like conventionally people have said that I'd be saving gold for my daughter's marriage or whatever it is, it's emotion. It brings tears to your eyes. Or it's out of a concern that what if, like Uday explained, the world is coming to an end, so you rush to buy gold. So it's never a proper financial decision because gold as a asset class does not have an underlying security. Let's put it that way. It's always bought on a periphery. It's always bought on the borders. So now, the current situation or what we've seen probably 6 months back, the Brexit situation developing globally or the recent demonetization effects has again been an effect of despair. So people do not know what is going to happen. And again, an emotion is charged within you and you rush to buy gold. So it's never probably been a properly thought out decision that when the going is good, that I'd go out and buy gold or something like that. So demonetization right now has brought gold onto such a, I would say, inflection point that we really don't know that which way the pendulum would swing for gold. So buy gold if you want to as 5 to 10% of your portfolio, and buy it in paper form. You have gold-based mutual funds, you have gold ETF, government has introduced the gold monetization scheme, the sovereign gold bond scheme. Buy it in that form. Please do not hoard gold.
Now, if Bharti Usha's query can be answered, Kalpesh, it's basically a comparative analysis that she wants in a certain sense. In 10 years, how much percentage of growth will take place in gold compared to, say, a PPF or other equity bonds, simply to understand, whether or not it's a good, option to go ahead and invest in?
See, the rise of gold in the last 10 years has been phenomenal. So if you see the period of, I would say, 2006 to 2013-14, gold has gone up manifold. And if it's just that period-to-period return, if you compare it, it would surely outbeat a conventional PPF or any government bond or something. Here, only thing what you need to understand here is that the PPF is always a tax-free instrument. The government bonds are also taxed. So PPF at one point of time, we've seen times where it used to be 12%. So that has now dropped down and it's coming down. So even today, PPF is now probably at around 8% in the recent quarter, which we've just witnessed. So it's actually a very difficult comparison. But if you just want to keep a preference of what you are looking at in your portfolio, your financial profile needs to be first checked.
Uday, you'll have to do a little more of crystal ball gazing, because Somesh Chatterjee, who works in the accounts department here, has a query. Returns on gold investment, like Kalpesh mentioned, was a little muted in the last 2 years, 2014, 2016. Now is looking upward. Where do you see gold investment market 5 years from now?
I will maybe not give you an answer what happens 5 years later, but I'll try to tell you what influences gold prices. What are the few things that influence gold prices? Many things influence gold prices. Now, what influences is that, one, what happens to the whole currency scenario? What happens to the inflation in India? If the inflation really shoots up, which means that our currency will start depreciating. If our currency starts depreciating, then gold prices will start going up, even if nothing happens internationally to gold. But if inflation starts coming under control in India, which it has over the last 1.5 to 2 years, then frankly, gold does not have so much appeal.
Well, the A to Z of investing into gold, but on that note, it's time to slip into a quick break. But stay tuned, a whole host of personal finance queries answered on the other side on NSE FinWiz. Welcome back. You've tuned into Season 4 of NSE FinWiz, and we have the participants here at Exide and Hosur scrambling to ask their questions to our financial experts.
I actually invested in mutual fund in a private insurance company, and after say around 4 to 5 years, I went to withdraw it. But whatever I actually invested, they said that because it is based on the market share and market up and down and all those things, I didn't even get whatever amount I invested into. It was much lesser than what I actually invested.
Okay, so first, I think I'll correct you and clear your, misunderstanding about the whole thing. At one shot, you have not invested in a mutual fund. You have invested in a ULIP. Because when you said that you have invested in a mutual fund with a private insurance company, those things are completely separate. So insurance companies which have an element of investments in it, if they are market linked, they are the ULIPs, which is unit linked insurance plans. And if they have an insurance come the traditional policies which they have, that is all the endowment plans and all which they have. So what you've done is you've invested in a ULIP.
I'm 52 now, and is it advisable to get into stocks? Because I have never entered NSE. I need your kind advice on that front.
First things first is that your age does not have to determine the kind of investments that you buy or don't buy. Your specific personal requirements is what should be determining what assets you should be buying or not be buying. Buying stocks on your own means understanding the market, understanding the specific securities, industries, spending that time and so on and so forward, to figure out what is doing well right now, what is doing well later on, and so on and so forth. If you think you have that inclination, then maybe you want to do that. But if you think, no, this is not something that I really enjoy and I have the inclination for, then just buy equity diversified funds. An equity diversified fund gives you pretty much everything that you can do by yourself.
On that note, we've been absolutely timed out on this episode of NSE FinWiz. From the entire team and all the participants here at Exide in Hosur, thank you so much, Kalpesh and Uday, for being part of this episode. Thanks for watching.
Focus, ideate, innovate, enable.